Well, hello there, Sugar Pie. Welcome to Economics with Ella.
Boom clap, boom de clap de clap, boom boom clap, boom de clap de clap.
Now, for those of y'all who are wondering who your host is of Economics with Ella, it's Ella. I was born and raised in a Texas town, and I love me some economics.
Move your feet. I'll give the barbecue show and tell you how to move. If you're
Welcome to Personal Finance on Economics with Ella. Hey Economics Pops, we're ready for David Broski.
We are, bro.
Oh, bro.
Myself, one of the things that I did, and life has changed. You know, people's careers are different. Different people are working. In some households, you have mom working and dad's at home. In some households, you have two people working. In some houses, it's one or the other. In my household, my wife had a job, very engaged in a career, fully employed, and when we had kids, it was her choice, and I supported her staying home. That worked out great for us. So that meant I was the major bread earner at the time. So I would say for any major bread earner, whoever they are, it's critical to have, when you start, some life insurance and to have disability coverage. Women are actually more capable and more apt to get disabled than men until they turn about 50, 55 years old. That's just an insurance statistic. So I'll get a little bit more into that, but in a life insurance product when you're really young can actually be very affordable. And I would encourage you, I'm not an investment advisor, I'm not a tax accountant, I'm not a lawyer, so I'm going to preface what I'm saying by I'm opening up my mind and giving you ideas. You want to talk to people who are expert in these areas to make sure that what I'm saying is best for you, like a life insurance specialist. But what I've seen is that if you buy a whole life insurance policy while you're young, it accumulates cash value, and it's a whole life insurance policy. It'll stay in effect until you die. That's a way to insure your life if something happens, if you have a significant other at some point. It is also a way to accumulate some generational wealth that you can pass along. Disability insurance is something that you want to consider because if you are the one who's gainfully employed, at some point if something happens to you, you want to have an income stream that you can replace. I personally just got rid of my disability insurance. I'm taking a look, and I'm looking at long-term care insurance now, which is the third ingredient. As a young person, you probably don't need to get that right away. That's for like nursing home and in-home care later on in life. But it's something to monitor to see what it's going to cost as time goes on. But for you to buy something like that now is really frivolous because hopefully you won't need that until, we're talking 50 years from now. That's a lot of premium to pay before you have finance. We'll talk about different topics as you ask me questions, but I have a strategy. It's just called the bucket strategy. Not kicking the bucket. It's not the movie, the bucket strategy, jumping out of airplanes, you want to go do that. None of that stuff. This is financial bucket strategy, okay? Envision, if you will, I have 3 buckets here, all right? I've got, is that a tip? So you have 3 buckets from left to right, okay? They're lined up over here, starting on this side of the room, then I'm the 3rd bucket. Okay, does that make sense? Just 3 buckets. And the deal with the buckets is you can move money from the left to the right. You could also move money from the right to the left, but that's the direction you don't want to go. So left to right, just like you're reading a book. So far make complete sense? Cool. Bucket number 1, that's your life bucket. Okay? Life bucket is basically where you have your budget. Okay, that is life. Food, clothing, shelter, all the things that you need to do go into a budget, an expense budget in that bucket. And the first line in that bucket is the earnings that you have. So when you get out there and you're working, you have revenue coming in, okay? And you have expenses going out. So like expenses, whether it's your housing allowance, if you're in an apartment, your mortgage, your clothing, your food, entertainment, anything you want to do with your daily life. Those are the expenses that go in that first bucket, and they're offset by the money that you earn. So who here thinks it's a great idea if you're earning $100 to spend $120? Does anyone particularly think that's a good idea? Good, that's a good answer. But what if I gave you a credit card and said, you have $100, you want to spend $120? Does that change your mind? Anybody? I mean, if you do, I'm not saying this to call anyone out. I want to have a discussion. Does anyone think that's a good strategy? I'm open to it. What are credit cards good for?
Spending money that you don't have at the moment.
spending money you don't have. So that's one view of it for sure. Is that, and that's what it can lead to. But how can a credit card be an effective part of a spending strategy?
Building credit.
Building credit, yes, sir. What else?
I was going to argue that actually it could work with that spending 120 thing. Because while you may be in debt for a little bit, when you earn $100 again, you pay it off.
Okay.
For the next time.
So what you're illustrating is the premise that people who are good with their money can take a loan from themselves effectively in the form of a credit line, and they can spend more money than they have, and at some point pay it back and net a profit, but do that. I don't disagree with that premise. In practice, how many people think that they have the actual discipline to do that regularly? That they would actually take the money? I see thumbs down there. The truth is that's an individual thing, and you make a very good point. But it is the case that many people start off like that when it's $100, $120, $20 difference, and they develop that kind of lifestyle, and then they really struggle because they never replace what's in the bucket. They now have less money than what they're bringing in. So the magic is, in this country, a lot of what you do, buying a car, particularly buying a house, you have to have a credit score. The only way you get to have a credit score is to have credit experience. Credit experience means you have debt, right? So debt comes in the form of a revolving credit line, like a credit card. It could be a term loan, like a car loan. It could be a mortgage. But the only way you get to the top end of the highest end of debt is to have the other types of debt first, right? So experientially, I actually think it's a good idea when people get to be about 11th grade, maybe 12th grade, parents involved in decisions at that point, having a credit card with maybe a $500 credit limit, and getting into the mode. If you're making money, if you're not making money, then that's a completely different ballgame, right? Then we're talking about supplementing your credit, which I'm not a big fan of. But if you have a job or you're making a few bucks, filling up a car with gas, whatever, just getting that credit card and learning how each month to charge a certain amount of money on that credit card, not exceeding about 1/3 of the credit line. So that's the magic. You don't really want to keep your credit cards more than 1/3 of the line outstanding. But let's say you have a $100 limit. I'm making that up. So $30 a month, charge it, pay it off, the entire balance that month. Charge it, pay it off. You're now building up credit. So that as you get older and you get to do bigger people things, you get a credit score that's upwards into the 800s. The higher it is, the better your interest rates are on loans. That's your ability to borrow money. Because the dirty secret about borrowing money is that you can get more money when you don't need it than when you do need it. Does that make sense? Banks want to make you a loan when you don't need the money. They don't want to make they really don't want to make you a loan when you need the money. Why do I say that, do you think? Does that sound crazy? Yes, ma'am.
Because they don't want to get in debt by you not paying them.
So, but why would I maybe be a better candidate why do I say that maybe I'd be a better candidate to get a loan when I don't really need a loan?
That would suggest that you're like financially stable, so that you would have a better chance of actually.
Correct, and that's exactly what I mean. It's not crystal clear, but thank you for grabbing that. So basically, when your finances are in really good order, a bank wants to lend you money. If I'm in the business of banking, I'm taking a risk when I make you a loan, so I would prefer you pay me back, right? So if I'm making that loan based upon credit score, life experience, the income you're earning, the more income, the less debt, the better financially prepared you are, the more money I'll lend you. Now, socially, when we think about that disrupts our thinking a little bit, because we're all sitting here thinking, but I need a loan. Why won't you make me a loan when I need the money? Now, I'm not saying a bank won't make you a loan when you actually need money, but if your finances are not in order at all, they won't make you a loan. And you know what? They're probably doing you a favor at that point, to be honest with you. I have people that want to buy a house at different times, and they're really not ready to do that. And it takes a lot of diplomacy and being polite to explain that to somebody, but I would rather advise someone to save money, make their finances in order, than to actually go into more debt and hurt themselves. Capitalism says that money goes to its highest and what use? Anyone? Highest and best use. So from a banking perspective, when their money is going out to be borrowed by you, that's the highest and best use of that money. But you don't always want to take it just because it's available, right? It's kind of the money game. Because banks actually borrow money at close to 0%. The Fed gives them Fed funds, right? They get funds from the Fed that they borrow. They borrow at very, very low interest rates right now. But what do they want to do with that money that they get from the Fed? They want to do what? Give it to other people. Give it to them or
to let them borrow.
Right, because there's this crazy thing, it's called interest rate spread. Have you ever heard that term before? Interest rate spread is the difference between what a bank receives from its debtors, right, in interest, minus what it pays for being a creditor themselves. So if they're lending money out, let's say a standard mortgage, average 4%, they're lending it out 4%, and they're getting that money at close to zero. What's the spread on that? 4% coming in, 0% going out. What's that spread? 1 minus the other, 4 minus 0. 4%. If you could borrow money for nothing and lend it to somebody else for 4%, would you consider being in that business?
Yeah.
So now let's look at credit cards. What's the average interest rate on a credit card? 15, 16, you get some gas cards at a 21% interest, that's a bargain, isn't it? So do you think on its face, if I told you today, I'm gonna hang out in front of the room for a little while, and that, you know what, I'll give each of you $1, okay, and then every 30 days, you give me 21 cents. But you still pay me back my $1 too. Is that a good arrangement for you? So then the same thought goes to every time you pull the credit card out of your pocket and say, that $100 I don't have this month, I'm not picking on you, I'm just engaging in what you brought up. It's a very thought-provoking conversation. So every time I spend that $100, that's $21 of interest on that credit card annually. So if I kept that $100 outstanding for the entire year, I'm paying $21 of interest. Does that seem like a good deal? But I need this. I gotta have it, right? And that's where wants and needs, you gotta do your own analysis. And so that's why bucket number 1, my full encouragement to you is know where you stand. There's nothing embarrassing about the amount of money that you make, and you get to make decisions about the money that you spend. And when those two function in concert with each other, you know, so if you want to change your budget, if you want to have more disposable income, or if you want the money you take in to exceed the expenses you have, what are your two main choices you have to improve that? You can do one of two things.
Spend less.
Spend less, great thought, or make more, right? Are either of those bad things?
No.
Not at all.